For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and healthcare? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
All right, welcome back. Another episode, Managing Your Financial Future, just counting the episodes upward. This is fun. This is great. I'm Johnny Dean, your podcast host. Thank you very much for tuning in, if we can still use the word tuning in after all these years. Years ago, I once said, don't touch that dial, and I thought, boy, does that put me back in the 1940s. But I'm going to say thanks for tuning in anyway, even though probably all you did was subscribe to the podcast or just you found us somewhere. I want to remind people once again here at the top of the episode that you can and should subscribe to this podcast. Go to Apple Podcasts or Spotify and subscribe. Get every episode downloaded to your device because you do not want to miss anything at all. I want to welcome my good buddy, Professor Rick Plum, Certified Financial Planner Professional. Hello, Rick.
Good morning, good evening, good afternoon.
I dragged you in.
Since I have no idea.
You have what? You have a cold. You have. I mean, I'm trying to pump everything up, and you got half a voice, if that.
Yeah, a little on the lethargic side.
Well, you are.
I'll be fine.
Okay, all right. I just make sure you hold the microphone right up, real close to your mouth there, and we'll make sure that you sound fine. No, I've been I've been in that position myself. Back I think around Christmas time, I had about a third of a voice. So we always muddle through as best we can.
Must go on.
Hey, it does. I mean, I just looked. We got another one coming up. We try to do these a few weeks in advance, but between the holidays and all that stuff, and January, and then while it drags into February, it's like, oh my gosh, yeah, we gotta get our act together here. So anyway, welcome to the show. I want to talk today about something that could potentially change with regard to Social Security.
Yes.
It has
with regard to taxation, yes.
Well, yes, yeah. This is the overall subject, Social Security, and the taxation of the Social Security benefits thereof. I'm not talking about the FICA taxes and all that stuff. That's not what I'm talking about. I'm talking about the taxation on your benefits, your Social Security benefits. And the reason I say that it could change is because there's talk, and there has been in the past, but there's talk now, maybe a little louder, about either lowering or eliminating the tax on Social Security benefits. And I am all in favor of that. I am 100%. There is no reason to tax the benefits. Zero. I don't care what you tell me. There is no reason to tax Social Security benefits. I'm not getting into that. Okay. But this, of course, has been brought up, as I said, in years past. But the reason I'm even mentioning it now, ahead of the discussion on taxation of Social Security and strategies you can employ, is because I never thought, Professor Plum, that they would get rid of the WEP and the GPO that we talked about.
That was quite a bit of a shock towards the end of last year, when they all of a sudden, and it came out fairly quickly, and it went through the House and the Congress in a matter of weeks. They got rid of the windfall elimination provision and the government pension offset, both things that were used to reduce the amount of benefits that certain individuals could receive. Now, everybody gets, even teachers and firefighters get their full benefits, no offsets, no reductions, nothing like that. So that's going to increase. And one of the reasons we didn't think they'd get rid of it is because they always talk about saving the supposedly so-called trust fund.
Please.
And they have to have money going in and money coming out. And this reduces the WEP and the GPO, reduce the money coming out of the trust fund. They got rid of it, so that means it's a bigger drain. And one of the reasons we thought they'd never get rid of the taxation is because it reduces the money going into the supposed trust fund. But they've obviously, they don't care one way or the other from a fiscal standpoint, which is fine. So there is more probability, I guess, or more potential that they may actually get rid of the taxability of the benefits.
Sure.
Now, as we talked about, it's not the tax on your earnings that go into the trust fund to pay for your benefits. This is the tax on the benefit itself. The taxation of Social Security started in 1984 from the 1983 reconciliation that it wasn't Greenspan maybe did with Reagan to save the trust fund. They started taxing Social Security benefits up to 50% of the benefit received. And then in 1993, President Clinton and they put together a rationalization of why they could tax up to 85% of it, which started in 1994. And so we've had the potential of paying income taxes on the Social Security benefits that we receive. And there's a lot of misconception about it. First off, it doesn't matter what kind of benefit you receive from Social Security, whether it be disability, survivor, your own retirement benefit, a spousal retirement benefit. Any benefit you receive from Social Security has the potential for being taxable. Now, I'll kind of eliminate SSI because the only way to get SSI is to have basically no other income. And that's the key, because it's not the Social Security benefit on its own that creates the taxation. Yeah. It's the Social Security benefit in conjunction with other income that you have.
Yeah.
Other pensions, other IRA distributions, interest, dividends, capital gains, any other any other income that shows up on the tax return has the potential for screwing up the taxation on your Social Security benefit.
Yeah. And we're going to get into that here in just a moment. So I want to just preface this, as I said, by saying that if at some point this year in 2025, they make changes to the taxation system or they eliminate it completely, this may change some of the things that we talk about. But we can't talk about things that haven't happened and may not happen. But I did want to throw that out, that could be the case. Now, you pushed about 4 buttons with me with that, funding of taxes, funding Social Security. But I didn't say anything.
Until now.
It is... I'm just pointing out that I didn't say anything. But I may. The whole idea of taxing Social Security benefits is completely ridiculous, and it's useless, by the way. So forget it. You can still get your Social Security payments no matter what. Doesn't matter what the ledger said. Anyway, all right. Let's move on from that, because that's not the point. The point is that currently Social Security benefits are taxed here in early 2025. And what you said, Professor Plum, just maybe expand on it for a moment so people understand this. How are Social Security benefits generally taxed? How much are they taxed? Some people have heard that 85% number. You mentioned it, I think, in passing just a minute ago. But can you clear it up in like a 30-second soundbite? How Social Security benefits are taxed?
About the taxability of your Social Security benefit. And right now, this podcast is coming out about the time that many people are doing their 2024 tax return. We're wondering whether or not they're going to get rid of the tax going forward. I doubt they're going to make it retroactive to 2024.
No.
So when you're doing your 2024 tax return, your Social Security will probably have to face the dreaded are we going to be taxed or not? And like I mentioned earlier, it's not the Social Security by itself that creates a tax on Social Security. It's the combination of Social Security and other income, any other income, including tax-free municipal bond interest. Qualified Roth distributions do not affect anything.
Yeah,
they are tax-free. They don't show up on the tax return. They're not part of the adjusted gross income, and they're not part of the calculation for determining the modified adjusted gross income calculation for determining whether or not your Social Security is going to be taxed or not. So qualified Roth IRA distributions are invisible for this whole discussion. Lovely, lovely things they are.
Yes, they really are. So other income, and as you said, even tax-free municipal bond income, just about anything except Roth IRA income, money from a Roth IRA, will count towards that. So if you only have Social Security as your primary, as your source of income, if that's your only source of income, even if you and a spouse are both getting $3,500, or what's the top number? We can't remember what it is.
Close to $5,000.
Oh, that's right. Yeah, we said that. I think I was surprised by that. We said that like a few months back. What the top Social Security benefit is, but even if you're getting, you and a spouse are managing to get that $5,000 or whatever it is per month. If that's all you have, close to $100,000 per year of income, you're not going to be taxed on it, correct?
No.
Yeah.
I'm looking at it in a very strange situation that I guess if both of you wait till age 70, you have no other income, and you both are getting $5,000 a month in Social Security because you're both high wage earners. Now, why would you have no other income? Why would you have no other any benefits, no savings, no anything else? But there's a potential at that level you could, because you're way over the mark. And yeah, there, I guess I can't imagine I can't imagine it happening in reality, but I can make it happen in a vacuum.
All right. So in the lab, in certain situations, test situations, you could potentially make that happen. But let's just say, for all intents and purposes, that if Social Security is your only income, then that Social Security is not going to be taxed. But if you do have other income, and many people do, I don't want to say most because I don't know for sure, but many people do have other income, pension income. You're taking money from your
IRA.
Your IRA. Yeah, exactly.
Capital gains. Yeah, and this is where it gets some people. You have a capital gain, and the capital gain, because of the way the tax bracket works, you may be in a 0% long-term capital gain bracket, but that long-term capital gain is part of the adjusted gross income, which is part of the modified adjusted gross income, which is what screws up the taxability of your Social Security. And so your Social Security taxation went up, and so you actually owed some tax because of that long-term capital gain you made, even though the tax was zero. Follow that?
Well, I do. But I assume people listening, maybe they can rewind it and listen to that. Well, but let's say you had a big home sale or something like that during the course of a year.
And any type of long-term capital gain, one time or over the multiple years, has the potential because it's part of that modified adjusted gross income. And what they do is they take a look at it. They put a formula together. And like anything else, it's easy to follow if you like formulas. If you don't like formulas, don't like math, you're going to be going, la, 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 don't talk to me. You take all the other income on your tax return, all your IRAs, pensions, interest, dividends, positive rental income, capital gains. You add all those up, and you take that number and you add to that half of the gross Social Security benefit that was paid for the year. Now, when I say gross Social Security, what I mean not the amount that's deposited into your bank account necessarily, the amount that's paid before they take money away from you for taxes, before they take money out of your benefit for your Medicare Part B, C, or D. So it's the gross payment paid. So if you're getting your payments, $2,000 a month, but you pay the $185 for Medicare, and you're only getting $1,700 a month deposited into your bank account. It's not the $1,700 they're looking at. They're looking at the $2,000 in that example. So they're going to take the $24,000. You take half of the Social Security
and add that
paid, and add it to all that other income. Now, if you're a single person, a single taxpayer, if that combination of all the income plus half the Social Security is more than $25,000, some of your Social Security is going to show up in the taxable column of your tax return. If it's more than $32,000, $34,000.
Yeah.
Remember here.
It goes 30. It was 30.
A larger amount of your Social Security is going to show up in the taxable column. It becomes part of your true adjusted gross income and becomes part of your taxable income.
Yeah.
The further over those thresholds you go, the higher the potential amount of your Social Security is going to go. At the most, though, the highest point, 85% of your Social Security could be taxable. So if you're receiving, $10,000 in Social Security, $8,500 of it could show up in the taxable column because that's the way it works.
Yeah, and it's taxed at whatever income.
Whatever your marginal rate is at that point.
Right. So if you're in a low tax bracket, you may not
pay anything on it anyway because it's part of your adjusted gross income. But then the adjusted gross income, you subtract out your standard deduction or your itemized deductions, and that may bring you back down into the zero area. But it is part of that adjusted gross income, and how much depends on your other income. So if you've got an individual who's got $50,000 of total household income, 40 of it's from pension, 10 of it's from Social Security, $8,500 of that Social Security is going to be taxable. They're going to have a adjusted gross income of $48,500. On the other hand, if you've got somebody who's got $40,000 of Social Security and $10,000 of other income, still $50,000 of total income for the household, none of the Social Security will be taxable because it doesn't. You add half the Social Security plus this, that, and the other thing, you're just not going to owe any taxes the way the formulas work. So how your income is structured has a lot to do with how much, if any, of your Social Security benefit will be taxable.
Yeah. Now, before we get into things like that could increase it, maybe in a surprising way, like through required minimum distributions, if you've been taking Social Security benefits for 10, 11, 12 years and you've never had them taxed, and all of a sudden your RMDs kick in, and now your Social Security is pushed into tax. Before we get into that, and before we talk about how to maybe mitigate that a little bit, talk for a moment. We mentioned the windfall elimination provision and the government pension offset GPO going away. There are some people who are going to be getting some back pay from those, from the elimination of that. Going back, how far? Is it just 24 or is it prior to
24.
that? Okay.
Payments after December 23.
Okay, so anything from January 1st of 2024 later on that you were entitled to now, according under the law, retroactively entitled to, there are some people that may be getting a fairly large check, a lump sum check, Professor Plum. Now, I don't know what the largest check would be for somebody who is receiving that, but how is that going to be handled from a taxation standpoint? Because obviously, if somebody adds $30,000-$40,000, or a couple adds $60,000 of back pay Social Security to their income, that would tend to push them up into a higher bracket and also push the amount of the Social Security up. Where if let's say they were receiving $20,000 a year in Social Security, but only a small portion of it was taxable because their other income didn't push it that high, and now they get a lump sum check for $50,000-$60,000. Now, if they had received that money the year they were supposed to receive it, 24 and 25, because these retroactive checks may not happen until late in 25, maybe not until 26. They've got to get their act together at the SSA, which we'll get into that later. But you might receive a big check. So if at that level, probably 85% of that check is going to be taxable. Whereas if you'd only received $30,000 a year instead of a check for $60,000 a year, maybe only 50% of it or 55% of it would have been taxable. So the Social Security, well, I shouldn't say Social Security, the IRS, and this has been on the books for quite some time. This is not a new issue. When you have a retroactive check from Social Security, which is a lump sum, you can calculate the tax two different ways and pay the lower effective rate. Now, you cannot amend, like in this case, we're going to get a retroactive check for 2024. We can't go back and amend the 24 tax return to show what we should have received in 24 from this lump sum. But what they do is they say, okay, let's calculate it, the 2025 tax return, as if the stuff was paid in 24, and then let's calculate how much of an impact the additional money would have made in 24. But so you're doing this crazy formula, and I've looked through this, and it's no bueno. It is not fun, but it may save you some taxes. And so you can either treat it as all in one year and just go with the flow and pay it, or you can split it into two different areas and say, well, if I had received it last year, I would have paid this much on that, and I would have paid this much on the money I received this year. Combine the two amounts and pay the tax this year. You're still paying the tax this year, the year you file for it, the year you receive the lump sum. You're just kind of splitting the payment into 2 years to see if you would have been in a lower tax situation by doing that. Maybe you're in a lower bracket, maybe you're in a lower percentage, but it could help if it was split over 2 years. Now, if the lump sum is, $600, $700, $800, not going to worry about it. But these lump sums, you said, how big could it be? I mean, again, in a vacuum, I could create a way that, let's say you've got a married couple. One person was a very high wage earner that they're maxed out their Social Security, waited until 70. They started their Social Security a year ago, 70 at $5,000 a month. And their spouse, because they've got a nice pension, doesn't get a dime of spousal benefits. I'm thinking it would have to be and then the person died in 2023, but the spouse didn't get the survivor benefit because the GPO wiped it out. But now they're going to get it, so they could get 2 years back pay of $60,000 a year. They could get $110,000, $120,000 back payment. That's the largest I think it could ever be. Yeah, and let me just
that will leave a mark on a tax return.
A huge mark. Now, let me just say again, when we're talking about back pay, we're going back and talking about people who were affected by the windfall elimination provision, the WEP, and the government pension offset GPO. It's not a ton of people. It is some people. So I don't want anyone listening to think, well, wait a minute.
1 million people.
Well, but I mean, in the scheme of things, it's a low percentage of people, fairly low, not a very low, but a fairly low percentage of people. I just don't want people to think, hey, we're all getting a back payment. We're not. It actually is people who are affected by that.
Right. But they've got a lump sum coming to them, and that lump sum is going to be taxable potentially, and how to deal with it. You can either deal with it all in one return or try to make it look like it was on two returns. But there are ways to try, and this is where accountants make their big money because this is a pain, but it works.
Yeah, it does. And it's helpful to be planning for this just in case. So if you are somebody who is going to get a retroactive check from last year for the WEP and the GPO, I would suggest you talk to your financial advisor. Like Professor Rick Plum, and at least have them look at it and see how this could affect you. So,
talk to your congressman and senator and say, get rid of taxation altogether on Social Security, and we don't have to worry about this.
See, another benefit of it. There's no downside. No downside. All right. So now, when we. How much time? I don't have a ton of time. I mean, we have some time, but I don't have a ton. But just talk for a moment before we talk about how to potentially lower this, Professor Plum. Things like required minimum distributions tend to hit people. Well, now if you're 73 or potentially 75 soon, having this extra income that they didn't have since they maybe started taking Social Security 10 years earlier, 11 or 12 years earlier. This can affect them in a big way as far as their taxation on their Social Security goes. You have all this extra income. Talk about that for just a moment.
Right. For somebody who has not needed to take money out of their IRA and has left it alone to grow, has not taken anything out, their RMD could grow nicely. I mean, the IRA could grow nicely, which creates a much larger required minimum distribution. That required minimum distribution is an IRA contribution or an IRA distribution, which is taxable. And so that goes into the modified adjusted gross income. It goes into that calculation, which is going to nail your Social Security. Now, if your Social Security if you look at the line that says Social Security, line 6, I think it is, and there's two lines. There's line A and line B, or box. If you're already at the 85% mark, none of this matters to you because any new income was not going to affect your Social Security. It's just going to affect your taxes overall. But a lot of people are sitting there, they look at box 6A where it says, I'm receiving $40,000 in Social Security benefits and $26,000 of it's taxable. Well, that's not 85% of it yet. So any new income they show is not only going to be taxable for the income standpoint, so that IRA distribution is going to be taxable, but it also subjected a big chunk of Social Security to taxation. We've seen this before where somebody has maybe a $10,000 required minimum distribution, but their taxable income goes up by $18,500. The $10,000 showed up as taxable income, but an additional $8,500 of their Social Security, which wasn't taxable before, also decided to show up as taxable income. And so even if they're in the 12% tax bracket, they were expecting, okay, I'm going to take the $10,000 IRA distribution and pay $1,200 in taxes. No, they're going to pay more. They're going to pay $2,200 in taxes. They're in an effective, much higher bracket because of that inclusion ratio.
Yeah.
So it's a weird game because sometimes we can look at it and say, well, you're pretty close to the top of the 85% mark already. So once you get past $2 or $3, it doesn't hurt. Now we're going back into a real bracket. It's weird.
It's weird and it's complicated. And I understand as people listening, maybe their heads are starting to swim and say, whoa, wait a minute, wait, hold on a second. Okay, so the bottom line on this, though, is that once you begin taking required minimum distributions, your Social Security may be forced into the taxable column, whereas it may not have been before. Or more of your Social Security may have been put into that column.
And this is where I had a debate with somebody the other day about whether a charitable donation is equal to or to the qualified charitable distribution. And this is where the qualified charitable distribution can help tremendously if you're charitably inclined. Because if all I do is take that $10,000 and as a distribution, and then maybe I give all 10,000 of it to a charity, just in a check.
This is your hypothetical $10,000 required minimum distribution.
Right, that I didn't need, and now I have to take because I'm 73 years old or older. And so I take the 10 out, and I happen to have enough deductions that I can itemize, and so I can deduct that $10,000. So I get $10,000 of income, taxable, and I give away $10,000 to charity, and in this example, it's all deductible. So I get 10, and I give away 10. It's all deductible. But my taxes still went up because remember what I said, that $10,000 IRA deduction in my hypothetical example increased my adjusted gross income by $18,500. So even though if I give 10 away, the 10 drops it again, but that $8,500 is still sitting there. By doing a qualified charitable distribution, instead of taking the money directly and then ultimately giving it to charity, just have it sent directly to the charity, it doesn't show up as my adjusted gross income. So it's a better way to do that if you are 70 and a half or older, and if you are charitably inclined. The QCD is a wonderful charitable qualified distribution.
Yeah, a QCD, we've talked about this many times on previous podcasts, that can help. This is one of the ways, and as one of my last questions to you on this, Professor Plum, was, well, what are some ways that you can potentially lower or maybe eliminate your the taxes on your Social Security benefits? One of the ways, as you just said, was through a qualified charitable distribution, or QCD, which sends your required minimum distribution, or some portion of it, if you like, however much you want, to a charity. Now, it's best that you were already going to give money to a charity anyway, because
it's not going to really help you that much.
I mean, it'll hurt you less than it would have, but yeah, it's something that you should already have in mind. Now, speaking of keeping things in mind, Professor Plum, before we run out of time here, talk for just a moment about, you said that the required minimum distribution, once you hit it at age 73, 74, 75, whatever it's going to be for you this year or in future years, the required minimum distribution can put a big mark on your tax return. Maybe you're not charitably inclined, or maybe you're not going to, whatever. It doesn't matter. If you can somehow reduce that required minimum distribution in other ways, talk about that for just a moment in the time that we have left.
Well, this is where understanding your tax return, the forms, and what's happening on them, it comes into play. Because as I mentioned earlier, if you know where you are on the taxability of your Social Security, maybe I'm at 75%. And I've got, I take another $5,000 out, I'll be at 85%. And my RMD, so I take my RMD. But even doing all that, I still have room, even with the RMD, even with a little bit more of taxation on my Social Security, I have room to do Roth conversions in the same tax bracket that I'm currently in. I've already maxed out my RMD, maxed out my Social Security taxability. So I've got room in the 12% or maybe the 22%. This is where I can start doing conversions. I'll never see this bracket again. I don't think unless they get rid of Social Security tax, but we'll see. But this is where understanding your tax return comes into play. Can I get back into a true 12% tax bracket? Instead of, once I max out the tax on my Social Security benefit, then I'm back into the true bracket. Now I've got some room, and I can do Roth conversions. Remember, these were people that were not taking their RMD to begin with, so they didn't need the money. So that's one way. If you can reduce the size of your IRA, you're reducing the required minimum distribution. Now, I don't want to reduce the size of my IRA by making losses, but I don't mind reducing the size of my traditional IRA by doing Roth conversions if I can do it efficiently.
Yeah, and when you say efficiently, just to repeat, you're talking about don't jump into, don't try, if you can, not to jump into the next bracket or higher brackets. I mean, it's up to you if you'd like to do that, but that's something you work out with your advisor. But if you have
a lot of them, if I'm in the 22% bracket currently, the next bracket's only 24, so it's only a 2% difference. So that's a nice little thing, because if I don't do it, I'm basically going from what was the 12 to the 20%. That's a big increase because of the Social Security. So we have to look at what's going on and maybe make things work on your behalf.
Yeah, and the idea of doing this is all to reduce the balance that's in the pre-tax portion of your IRA. Take it out of the pre-tax portion of your IRA, pay taxes on it, and so by the time you get to your required minimum distribution age, whatever it happens to be, in theory at least, the balance will be lower at that point because you've been converting money out of that pre-tax account. And since the balance, and since the balance is lower, that would mean a lower required minimum distribution.
And the reason John keeps going back and forth between 73 and 75 is the required minimum distribution age is currently age 73 for anybody born in 1959 or earlier. But for people born in 1960 or later, the required minimum distribution age is 75. Those individuals do not have to take anything at 73, 74. They have to wait. They can wait until 75, but that gives them more time to do tax planning and do Roth conversions, because you cannot convert an RMD. But if I don't have an RMD, I can do my conversions.
Very helpful. This is all part of tax planning. It's one of the few things, Professor Plum, that you actually benefited from. You got in just under the wire or past the wire or whatever it was. You made it by, half a year to the 19.
Age 75, yes.
Yeah, your required minimum distribution is age 75, as is mine, at least as under current law. So.
Yeah, we'll see if they. I haven't heard anything about pushing it out further, but we'll see.
I haven't heard anything either. I think my guess is they're going to leave it alone for a little while. They have other things supposedly that they're going to work on. Honestly, I do not know. My head is spinning. I not even going to predict what's going to happen over the next month, much less the next year. But this is just something you need to be aware of. What we talked about today had to do with your Social Security benefits being taxed. How can they be taxed? What pushes them into taxation? And what's a good way to potentially lower that tax? And again, for the folks who may be getting a retroactive check in 2024, there is a formula already in place to help you determine how much is taxable, and you have the choice of doing the lower amount. You have to run it both ways. I assume something like TurboTax next year will do that, but I don't know.
Haven't tried it, so I don't know.
Yeah, I don't know either. It's all fairly new. If you want to know more about this stuff, and especially if you are affected by that lump sum payments from the GPO and all that stuff, the WEP, I would highly advise, as I said, you should talk to your financial advisor. Even if you're not, if you've got required minimum distributions coming any time in the next 10, 11, 12 years, and you're already taking your Social Security, or you're going to be taking your Social Security fairly soon, talk to your financial advisor. Talk to Professor Rick Plum or any of the Lucia Capital Group advisors about this, because the sooner you plan for this kind of stuff, the better off I think you're going to be. Professor, you talked about when they push this out to age 75, it gives you a couple more years to plan. Well, if you're going to be taking your Social Security at age 62, 63, 64, whatever, and you don't need the money from your IRAs, your pre-tax accounts, it's probably a really good idea to start planning, or at least looking at right now, 10, 11, 12 years ahead of those RMDs, looking ahead and saying, well, maybe I can take some of that money now. Maybe I should reduce some of that IRA balance. Would you agree?
I agree. And even if you don't need it right now, doing Roth conversions or getting it out of there helps your required minimum distribution planning in the future.
Yeah. And
use the tax code to your advantage rather than letting it just bite you in the tail because you weren't aware.
100%. 100%. Talk to them at 800-644-1150. 800-644-1150. You can call any of the Lucia Capital Group advisors. Professor Plum is watching over them, and he is the chief financial planning officer for Lucia Capital Group. So anything that you hear Professor Plum say, the rest of them do exactly that, and they're all working together as a team. Lucia Capital Group, 800-644-1150. We thank them as our long time sponsor of this particular program. You also can go online at luciacap.com, LUCIACAP.com. Find a whole bunch of videos on there, blog posts, segments, audio, bits of whatever. I mean, there's so much information there. I would suggest you go there and read through it. And don't forget, you can also download the Social Security Guide. We have one up there. Also have a retirement guide, a bucket strategy guide, and estate planning guide. Just type any of that into the search bar in the upper right-hand column, and you can download your own copy, obviously free, and read it. Read it at your leisure, or leisure, potentially. I would suggest you do that because there's an informed person is a smarter person is a much better planner. And I think, Professor Plum, you would agree that if you're talking to somebody across the desk, you would love for them to be as informed as possible about what it is. Not that you're doing, not only that, but they understand things like tax brackets, which is why we talk about it on this program.
Well, it helps your own sense of comfort if you know why you're doing something and you know that it's benefiting you for what you're doing.
Yeah, that's exactly true. I mentioned at the top of the show, don't forget, you can subscribe to this podcast, Apple Podcasts, Spotify, all of that stuff. Go there and make sure that you get these episodes downloaded to your device every single week, and you can just sort of binge listen to them or listen to them whenever you can. Speaking, by the way, of tax brackets, Professor Plum, I think maybe, because we had an email on this, I think maybe next week we will cover something about the 0% tax bracket. I know we broached it a little bit here today, but people do look, as this emailer did, and said, wait a minute, I don't see a 0% tax bracket. What are you talking about?
Well, there technically isn't one.
Right. But there
is. Write it.
There is, but there isn't. So I think maybe we'll talk about that. And since people are doing tax planning now, presumably, if you're listening to this anytime close to when this episode dropped, you're doing some tax planning. And tax planning is not just for, the January to April time period. You really need to be thinking about this. So I think next week we're going to talk about that here on this program. Professor Plum, I thank you. I really do.
You're welcome. You're welcome. You're welcome.
Nice to have you here, and we'll see if your voice is any better next week. I have a feeling it's not going to be because we're going to be recording this next episode fairly quickly. But either way, I appreciate you being here. For Professor Rick Plum, Certified Financial Planner Professional, I am your podcast host, Johnny Dean. This has been Managing Your Financial Future. Thanks so much for listening. And, of course, we'll talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. You should always seek counsel of the appropriate advisor prior to making any investment decision. All investments are subject to risk, including the loss of principal. This material is gathered from sources believed to be reliable. However, its accuracy cannot be guaranteed. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There's no guarantee that you will achieve the results discussed or illustrated. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules could be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. Municipal bond interest may be subject to the alternative minimum tax. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC.